Well, hello, everyone. Cynthia Tomaine here with Interactive Brokers, and thank you for joining today's presentation brought to us by WisdomTree Europe, where we're going to be discussing Brit-in or Brexit and hedging in times of geopolitical uncertainty. Now, I'm very pleased to have with us today Nick Lung, who is a research analyst for WisdomTree Europe. He is responsible for macroeconomic commentary and analysis, formulating investment strategies and trade ideas, as well as maintenance of research collateral. So would you please, oh, and by the way, Nick has his master's degree from Imperial College in London. So would everyone please join me in welcoming Nick. Nick, I see you've unmuted your phone, so I'm going to pass you the ball, and let's get underway. Thanks for joining us, Nick.
Hi, guys. Thank you for dialing into this presentation. Let me just adjust the screen. I think that looks good. So today we're going to be talking about Brit-in or Brexit. But before we get started, I do actually have a quick disclaimer that I'm required to read out. This presentation is provided for your general information only and does not constitute investment advice or a recommendation to buy any investment. This presentation, therefore, should not be relied upon to make an investment decision. Please consult your financial advisor before investing in our products. And of course, due to compliance reasons, this presentation will purely be educational, giving an overview of what Brexit means for the UK and Eurozone economy, as well as looking at current investor positioning. So, yeah, let's get started.
Nick, we seem to have lost you.
Yeah.
Oh, there you are.
Sorry. Yep, I've got it. Okay, so let us start off by looking exactly at what the main arguments are for each camp with regards to the key points surrounding trade and the UK economy, immigration, cost of EU membership, sovereignty, regulation, and security. Now, starting off with Brexit, the main arguments for Brexiters is that Britain has the ability to negotiate favourable trade deals without having to be a part of the European Union. The European Union represents a declining trade market for the UK, and there's no reason why the UK cannot thrive outside of the EU. I mean, looking at the examples of Norway and Switzerland, it shows you that these countries have traded and prospered outside of the EU, and there's no reason as to why the UK cannot do the same. Now, the main sticking point, the main argument for Brexit actually revolves around immigration, and the argument that the UK has in fact lost control of its borders, with net immigration in 2015 at 330,000, and the government's target is actually 100,000. So you can see that for a lot of people supporting Brexit, it would appear as if UK immigration is completely out of scale and we have totally lost control of our borders, putting additional pressure on already strained public services, including housing, including schooling as well. And with about half of last year's net immigrants, so about 150,000 being from the EU, the argument is that Britain needs to exit the EU in order to regain control of its borders. Now, moving on to cost, Brexiters argue that membership to the EU is expensive, costing about £18 billion a year. And this is money that could be better spent on essential public service works, building out infrastructure, and basically money that doesn't need to be spent being sent to the EU for other purposes. In terms of sovereignty, the argument for Brexit is that Britain has forfeited its sovereignty and, given up significant rights in being able to govern itself as a sovereign nation. But of course, by leaving the European Union, the UK has the opportunity to retain its influence and kind of regain control of lawmaking in its own country. And this also ties in with regulation and the argument that the EU is over-regulated, putting excessive regulation on UK businesses, which is stifling, in particular, the small and medium enterprises. And the idea is that once free from the EU, UK businesses will be able to thrive, being freed from unnecessary bureaucratic intervention. And now, in terms of security, this also links back to immigration, the idea that the open border scheme in the EU, the free movement of labour, prevents the UK from checking and controlling people. And, this presents an issue for national security, since you've had terrorist attacks in Paris and Brussels. And, of course, naturally, people are concerned. They're worried about whether or not this is likely to happen in the UK. And if the chances have increased, given the fact that we can't control who comes in and who comes out of the country. Now, turning to the Remain camp now, which we have termed Brit-in. The main argument for Remain is the fact that as a member of the European Union, Britain has unlimited access to the single market. And this is essential for Britain's economy and trade, especially since the EU represents 50% of the UK's trade market. And of course, there's also no clarity on what post-Brexit trade would look like. Are we likely to follow a model under Norway or Switzerland? Well, under Remain, the argument is neither, because both models simply wouldn't fit the purpose for Britain. And in terms of immigration, the argument for the Remain camp is that, yes, immigration has increased over the past few years and is above the government's target, but at the same time, the net effect of immigration has undoubtedly been positive. You have migrants coming into the workforce, paying their taxes, and contributing to the economy. And, Britain really needs these skilled but also unskilled labour that the EU provides. And, at the end of the day, even if we leave the EU, this isn't going to stop in immigration. Immigration will continue regardless of whether or not we're in the EU or outside of the EU. With respect to cost, the Remain camp argue that Britain's actual net contribution to the European Union budget is not 18 billion, but is in fact only 8.5 billion, especially once you factor in rebates and EU spending on the UK. And this is actually a small price to pay in order to have access to the single market and all of these other benefits that being a member of the European Union provides. In terms of sovereignty, the fact that we're having a referendum is proof that the UK has not lost sovereignty. And it still remains the fact that important laws and policies are still set by the British government. For example, you have the increased minimum wage coming into effect later on in the year. And this is a law passed not by Brussels, but by the British government. And, it's a clear sign that Britain's sovereignty has not actually been impeded by being a member of the European Union. At the same time, much of EU regulation and laws actually helps make life easier and safer for UK consumers. The EU also guarantees equal rights and labour standards. And finally, in terms of security, Britain is simply stronger working with the EU in tackling rising geopolitical tensions in the world by being able to share intelligence and information with one another. It's increasingly important that we do so, and this is only going to be effective if we are working together as part of one union in order to tackle this. Now, that's a rough summary of what each camp stands for. If we want to take a look at what the polls are saying, it's clear that since the referendum was announced back in the last general election last year in May, it's clear that there's been no the shift in momentum has really stayed the same, and you can't really split between the stay or the leave camp. It's pretty much been neck and neck the whole way through. Now, in the past few weeks, we have seen a slight pickup in momentum for the leave camp. And, you know, what this all means is that ultimately there's going to be significant uncertainty surrounding the result. It is really too close to call. And, of course, the outcome of the referendum will ultimately depend on trying to take the votes of the undecided, which currently stands significantly at about 15%. So that's 15% of voters still don't know how they're going to vote in the EU referendum, which is, you know, in 2 weeks' time. But of course, in order for either side to actually to win, it's key that unlocking the votes of young people, so the 18 to 24, the 25 to 34-year-old demographic age group, is going to be key. Because if you look at the chart on the right-hand side, you can see that voter participation, when broken down by age group, has been significantly lower for these younger demographic age groups than it has been for the older population. And in order for either side to claim victory, it's going to be important to both unlock the undecided voters, but also try to rally young people to vote in their favor. Now, of course, young people tend to be more prone to staying in the EU, being more open-minded and being, you know, having been raised in a, you know, in this liberal multicultural society. And, you know, that is one reason why the Remain camp have also been trying to target these young voters, trying to get them to engage and be active and make sure that they can secure their votes. So now we're going to look at the economics of Brexit and what Brexit actually means for UK assets. Now, there's no doubt that Brexit puts UK assets at risk, in particular the sterling and UK gilts. And to understand why this is, we can take a look at the UK's balance of payments and also take a look at the UK's current account deficit and fiscal deficit. Now, the UK's balance of payments, essentially a record of all economic transactions that take place, shows that we are in a precarious position. Over the past few years, our current account deficit has widened, largely reflective of the UK's economic imbalances, namely an over-reliance on domestic demand, with not enough spending on investment or manufacturing. Now, since the UK is a net importer of goods, services and capitals, this has led to an increased reliance on foreign capital inflows. And this is represented on the chart on the left-hand side by the red and the yellow bars. The red bars showing net portfolio investments, and the yellow bars showing net direct investments. And these are basically capital inflows from foreign investors into UK assets such as UK equities. And the scale of the bars, the red and the yellow bars, are now at extreme levels last seen during the financial crisis. And these capital inflows have helped to sustain the sterling. But as a result, they also leave the UK highly vulnerable to swings in market sentiment. Anything which threatens to undermine investor confidence in UK assets, such as a Brexit vote, could ultimately lead to capital flight and a collapse in the sterling. And, you know, we've already seen some pressure on the sterling as a result of weaker foreign capital inflows. Now, what this means is that the outlook, of course, for UK gilts is linked to the sterling, since investors typically choose to invest in UK gilts because of the pound's stability. As you can see, foreign investors play an important role in the UK gilts market, representing some 35% of, holding 35% of all total UK gilts outstanding. Now, if anything were to undermine investor confidence in UK assets, UK equities, the sterling would of course weaken, and so would investor appetite for UK gilts. And a sell-off in UK gilts would push up borrowing costs for the UK government, with higher bond yields, making it more difficult to finance the current fiscal deficit. Now, we're just going to focus a bit more on the current account deficit, since this is a central argument in the Brexit debate. As it stands, the UK's current account deficit is the highest it's ever been on record, at 5.2% on GDP. Now, what we've done here is we've broken down the current account balance, looking at the balance with the EU and also balance with non-EU countries. And you can notice that the UK is a net importer of goods, services and capital from the EU. That's shown on the left-hand chart, with the scale of the red bars showing that this deficit stands at about 6% of GDP. By contrast, with regards to non-EU countries, so the likes of China and other emerging countries, the UK is actually, well, if you ignore the last observation, the UK is actually a net exporter of goods, services and capitals to non-EU countries. Now, the Brexit argument is that because of our deficit with the EU, this puts the UK in a strong position, since European countries would be keen to maintain trade relations with Britain in order to maintain their export earnings. At the same time, the UK would be freed from the burdens of EU regulation and, as a result, would be able to boost trade with faster growing parts of the world, such as emerging countries and China. And they could do this by eliminating tariffs and signing trade agreements without the constraints of EU membership. However, for the Remain camp, this argument simply doesn't address the fact that the UK represents only 5% of EU trade, whereas the EU represents 50% of UK trade. So it's probably safe to say that the UK relies more on the EU for trade and vice versa, putting the UK in a weak position to dictate terms of any trade negotiations. At the same time, whilst it is true that emerging countries are playing a much more important role in trade with the UK, much of the UK's ability to trade with such countries hinges around continued membership of the EU, with the European Union bloc as a whole better able to offer favourable bilateral and preferential trade agreements with these emerging countries. On its own, the UK would undoubtedly have less bargaining power than the European Union. Now, ultimately, as we mentioned earlier, the outcome of the EU referendum will be decided by the undecided voters. And, of course, this in turn comes down to hard economic fundamentals. Now, if we consider the late recovery in the UK's labour market, you can see that incomes have only started to meaningfully improve since around mid-2014, following years of declines after the financial crisis. The regular average pay of workers employed in the private sector has reversed and begun to outpace inflation only after unemployment has fallen back to pre-crisis levels. And because of this, with households finally seeing some meaningful improvements in their incomes, we feel that British voters will ultimately choose to stay in the European Union, opting for a Brit-in, and avoid potentially undermining the hard-fought return to economic stability. Now, we encountered this situation, well, a similar situation anyway, in the Scottish referendum in 2014. And it was here that elderly concerns about social security and concerns with unemployment amongst the young helped eventually tilt the vote in favour of Scotland choosing to remain as part of the UK. And the end result was that concerns over national identity, similar to what we're seeing in the EU referendum in 2 weeks' time, concerns over national identity, they were ultimately sidelined in order to secure broader economic prosperity. And given the hard-fought economic gains by Britain over the past few years, we feel that similar voting behaviour is likely, and that the preservation of the status quo, that is, preserving the imperfect union with continental Europe, is going to be the preferred outcome for UK voters. But of course, regardless of the EU referendum outcome, we believe that Eurozone growth prospects are unlikely to be derailed significantly. Why is this? Well, simply because the structural shift in the Eurozone economy towards more domestic demand-led growth is finally picking up, making the economy less prone to external shocks such as Brexit. Now, if you look at the chart on the right-hand side, what we've done is shown a breakdown of the cumulative contribution to Eurozone GDP broken down by individual components. So you have net exports, stock building, investment, household consumption, government consumption, and that is all overlaid against GDP, cumulative GDP. Now, you'll notice that domestic demand, as shown by the grey bars, is indeed picking up. And at the same time, exports, which have been the main driver of growth in the Eurozone since 2010, has remained stable. And this is unlikely to change in the event of Brexit, especially since, if you remember, the UK only represents 5% of the EU's trade market. Now, the Eurozone is indeed in the early stages of this structural shift towards more cyclical-led growth. But especially if you compare against the chart on the left-hand side, which shows the same for US GDP since 2010, broken down by individual components. And you can see that since 2010, domestic demand has shot off and completely been the main driver of GDP over the past few years. And we believe that the Eurozone rebalancing towards domestic demand is set to continue, and for two key reasons. The first of which is the strengthening labour market. Now, the Eurozone jobs recovery is roughly 3 years behind the US. So the chart on the left, you can see that whilst the US lost more jobs following the financial crisis, losing approximately 8-9 million jobs over the 2 years from 2008 to 2010, the flexibility of the labour force positioned it to recover a lot quicker. And in 2016 so far, the US has actually added about 4 million jobs, right? When you compare that to the Eurozone, we're still about 3 million jobs down since 2008. And, you know, there's a lot of reasons behind this, one of which is the continued labour market inflexibility that we're seeing in various Eurozone Eurozone countries. But of course, since mid-2013, Eurozone payroll numbers are recovering, and the pace of the broad-based rebound in the labour market will depend on faster implementation of labour market reform, especially in countries like France and Italy. And this will lead to more job growth, but also lead to should also contribute to boosting productivity and lowering unit labour costs. And indeed, Italy has already started implementing labour market reforms in the private sector, introducing measures such as reducing employment security and also cutting unemployment benefits at the same time. And France is doing something similar, introducing reforms, giving companies more flexibility in terms of hiring, firing, and pay, and this is done according to economic conditions. So if underlying economic conditions are not good and a firm is not making that much money, then French companies now have greater flexibility in hiring and firing their workforce. So in a nutshell, what this means is that an improving and more productive labour market in the Eurozone will boost household incomes, and this will feed through into more discretionary spending. And all of these things are catalysts for better domestic demand growth going forwards. Now, aside from an improving labour market, we also have a more accommodative credit environment for small and medium businesses. And this is the second reason as to why we believe domestic demand-led growth will continue to strengthen. You have additional stimulus measures from the ECB in the form of long-term rebalancing programs aimed to boost the supply of credit by encouraging bank lending to small and medium enterprises. And this presents an opportunity for Europe's small businesses to get a funding boost and to use this extra credit for investment purposes, for expanding their workforce, and for increasing capacity. And as a result of these policies, we are seeing evidence of a more positive credit environment. Now, if you look at the first chart on the left-hand side, you can see that we're seeing falling interest rates with regards to loans to small, medium businesses across numerous Eurozone countries. And at the same time, we're also seeing a pickup in loan volumes, as shown by the vertical bars, a pickup in loan volumes to these SMEs, suggesting that there's both an appetite for cheap credit and also a willingness from banks to lend to these SMEs. Now, in this increasingly supportive environment, this is feeding through into business confidence, and we're seeing a pickup in business confidence, as shown by the SME sentiment indicator on the right. And this is showing a broadening out of the recovery amongst small businesses over the past few years. Now, because of these two factors, so an improving labour market and a more accommodative credit environment, these are the underpinning factors which should push domestic demand-led growth over the next coming years, and is also the reason why we feel that a Brexit shock would not be felt as much in the Eurozone economy. Now, with just 2 weeks to go until the referendum, it's clear that FX markets remain tense. If you look at implied volatility on GBP-USD options, this has spiked to levels last seen during the Eurozone crisis. In fact, over the past few days, it's actually spiked to 22% levels last seen during the financial crisis. And what it shows is that investors clearly are nervous about the outcome. The swing in the polls doesn't help, and with the bookies shortening odds on leave, there's no way of predicting what is going to happen. And at the same time, there's clear signs of investor risk-off positioning as well. If you look at the chart on the right, which shows flows into gold exchange-traded products since 2006, you can see that there's been a significant spike in inflows into these gold ETCs year-to-date so far. And this basically shows how investors are undoubtedly scared and are looking to allocate into safe havens as a means of protecting their portfolios. Now, if we look at broader European-domiciled funds, so looking at mutual funds and ETFs, this also cements the fact that market sentiment is in clear risk-off mode. Looking at the top line, you're seeing outflows from both UK equity mutual funds and UK equity ETFs. At the same time, investors have been increasing positions in both UK fixed income mutual funds and UK fixed income ETFs. And we expect this to continue, this risk-off positioning to continue. But at the same time, how bad can it really get? How bad will Brexit really be on financial markets? Well, to help us kind of have a rough estimate of this, we've taken last year's Greek referendum as our best guide for how we think markets will react in the upcoming referendum. Now here, what we've done is taken the Greek referendum last year. So it was the referendum for the Greeks to accept the terms of the bailout offered by the Greek creditors. And we've looked at 30 days prior to the referendum and 30 days post-referendum, tracking a range of asset classes and benchmarks. So you have your equity benchmarks, the FTSE 100, Eurostoxx 50, and you also have government bonds as well in the form of UK gilts and bunds. And what we're seeing here is clear risk-off positioning in the build-up to the referendum last year, with equities selling off and safe havens, so government bonds, rallying. Now, of course, the similarities are limited since the threat of Greece's default and exit from Europe last year isn't comparable to the economic impact of the UK leaving the single market. But of course, this is the closest that we've come to a country actually leaving the European Union. So we feel that there are similarities to be drawn from last year's referendum. So, you know, based on this, you would expect equities to be selling off and safe havens to be rallying at the same time. Of course, we've actually entered this 30-day period, and you know, we're not seeing the exact same thing happening this year. This year's Brexit appears to be a slight contrast to last year's Grexit. Compared to the same period last year, equity markets in Europe so far have remained resilient, and the FTSE 100 and Eurostoxx 50 are up about 2–3% respectively since the 12th of May, since the start of the 30-day pre-referendum period. Now, of course, last year's sell-off in the equity markets was also impacted by heightened volatility as a result of slumping crude oil prices and also continued fears of a slowdown in China. So, you know, you have to kind of judge whether or not the reverberations of Brexit this year will be similar or not. But over the past few days, what we're seeing is a slight downturn in equity markets. So, of course, it could be that the markets have had a delayed reaction, and as we get closer to the actual referendum date, you could see increased risk-off positioning take place. Now, that was an overall summary of what Brexit means for the UK economy and the Eurozone economy, as well as looking at how investors are positioning and how markets are reacting in the build-up so far. Now, I'm happy to take any questions if there are any. Let me just fix it here.
Well, hello, everyone. And if you do have any questions, I want to remind you, if you happen to have expanded your view into full screen access, notice the blue bar up on top of the screen includes the chat panel where you can access any of those, or the chat panel to be able to view or send any of your questions to Nick at this point. Now, while we are waiting for any additional questions, I also have one piece of business that I do need to run in each of our sessions. So what I'm going to do right now is open up a polling panel on your screen. You'll see, let me quickly go in and get my poll open. There are 3 short questions there, and I do ask that you take a moment. Let's go ahead and open that poll. I do ask that you take a moment and just answer the multiple choice questions that I have included here. Notice that 3 questions are included, and then there's a submit button in the lower right-hand corner of the screen that will actually allow me to compile the results of today's presentation. Poll is only open for just a few more seconds, so if you would, please submit any responses at this point. Thanks, everyone. Your input really is very helpful. And by the way, okay, poll has ended, so thanks, everyone. I appreciate that feedback. But do be aware that if you do have any additional questions, go ahead and put those into the chat panel for Nick to see and respond to here today.
Okay, so I have a question from Paul, which is how long would a Brexit transition process take, and what would this end state look like? Now, in the event of a Brexit, it would take roughly 2 years for the whole process for negotiations to commence and finish. So during this two-year window, the UK would be negotiating terms of exit with the European Union, looking to, at the same time, repeal any European legislation and also put in place its own trade agreements with other countries as well. Now, we're not entirely sure, well, no one is entirely sure actually, what an end process, well, what an end situation would look like, especially in the event of Brexit, since you can't really base it around the Norwegian model or Swiss model, because first of all, with the Norwegian model, under the Norwegian model, they have full access to the single market, but at the same time, they still contribute to the EU budget and still have to accept free movement of labour. So these are two main sticking points for the Brexit camp. They wouldn't want free movement of labour, and at the same time, they wouldn't also want to be continuing to pay into the EU budget. At the same time, under a Swiss model, that also wouldn't be effective for the UK, since this is built primarily on a number of patchwork negotiations with the EU, and this has taken, a very long time for these negotiations to be compiled. And at the end of the day, the Swiss model only grants partial access to the single market. And also, the Swiss, they have no control on immigration as well. They have to accept free movement of labour. So, there's no precedent with existing countries as to how a UK post-Brexit model would actually look like. I've got another question from Brent, which is what type of BOE, ECB or Fed response would you expect in response to a Brexit? Well, in the event of Brexit, given the tightening of financial conditions expected, you would expect the Bank of England to come out and probably cut interest rates in order to provide a more accommodative environment for UK businesses, and to counteract the general tightening in financial conditions that were to take place. Now, obviously, with the ECB and Fed, it's a lot more difficult to tell, since they're looking at Brexit, but Brexit is not the main driver for their policy response. But I think with the Fed, in the event of a Brexit, whatever slim chances remain of a July rate hike will probably be pushed further back, given the expected market uncertainty that we're likely to encounter. I have a question from Terence, which is, there's been no mention of hedging. Does that mean there's no point? No, that doesn't mean there's no point. But due to compliance reasons, we weren't allowed to use specific products, which initially was the idea, to use some of our products in order to present specific hedging examples and how investors can position. But yes, as I mentioned, because of compliance reasons, this webinar has had to be an educational overview, has had to be, just providing an educational overview of Brexit and what it means for the UK Eurozone economy, and how investors are positioning, really. I've also got another question from Paul, which is, I've read that Brexit would impact the city adversely. Would the lost jobs in the UK financial sector relocate to Germany, France, or the USA? That's a good question. I mean, there's plenty of opinions floating around in the city. People are fearful that in the event of Brexit, given the uncertainty surrounding the terms of exit, we're likely to see a loss of a large number of financial services jobs. And, these could go to different cities in Europe, Frankfurt, Germany, in France, for example. But at the same time, people remain confident that the UK still has some competitive advantage, whether we are in the EU or not. We have a flexible labour force, we have a English-speaking workforce, and of course you also have the infrastructure in place, which means that, even in the event of Brexit, it's not likely that we're going to lose significant numbers of jobs from the city. Yes, there may be some losses, but I think it's a stretch to say that we're going to see a new financial centre emerge in Europe somewhere. Do we have any other questions?
Well, if there are no additional questions, I want to thank Nick Leung and WisdomTree Europe for bringing us today's presentation. Very interesting information. Thank you so much, Nick, and WisdomTree for making today's presentation possible. By the way, I do want to let you know that today's event has been recorded, and you'll all get a direct link to today's recorded playback soon after this session ends. And by the way, the slides will also be available to you as you exit today's event. And I believe there was a question earlier from Matt on that. So I want to thank all of you for participating with us here this afternoon, and want to thank WisdomTree once again for today's presentation. So thanks, everyone. We are going to conclude our event today. You can exit using the X in the upper right-hand corner of the screen, and be on the lookout for those webinar notes as you do exit today's event, or simply check your inbox later on today for a direct link to both the recording playback and today's presentation. So once again, thanks so much, Nick, for today's event, and thank you for attending. Have a great one, everyone.
Thank you. Bye-bye.